Hi everyone, welcome to another live webinar of FXtrade.com. As you know, we have been working on this beginner's corner to help starters to understand a lot of different things about the forex market and from different points of view. That's the idea of getting such a great invite as Boris today, right? I really hope you enjoyed this webinar today, and I hope you really take the knowledge he will share with all of us. Hello, Leo. Nice to see you. Hello, all. Anyway, I was saying I really hope you take all the knowledge you will get out today from Boris and apply it into your trading strategies. Okay? Having said so, I will let him start with the webinar, and I will be here listening as any other good student. Okay? Thank you.
All right, guys. Thanks for coming in. Okay. Today's webinar is going to be a little different from all the other ones we do. It's going to be much more basic because this is really sort of for beginners. And it's going to just talk about the underlying fundamentals of the market, kind of ideas that you need to keep in mind. And then we'll talk a little bit about maybe my most recent trades, what we're doing, take a few questions, and and then we'll wrap it up. By around like 12:30, 12:45. Hopefully, you guys, will have any questions. Any questions that you guys have, keep posting them. I have a couple of screens here so I can see your questions. And I'll be happy to answer them as we go along. But I just wanted to, start this. For those of you who may have been at the New York show, you probably have seen this webinar. For those of you who haven't, this is a good chance for you to take a look at some of the slides that Kathy and I talked about. This is the website, by the way, that we run called BK Forex Advisors. That's our proprietary signal service. You're welcome to come in and join us anytime you like. But right now, I'm just going to basically talk to you a little bit about everything that we do. Let me just read the disclaimer. Trading foreign exchange or margin carries high level of risk and may not be suitable for all investors. High degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. A probability exists that you could sustain loss of some or all your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading. Seek advice from an independent financial advisor if you have any doubts. Kathy, Lena, and Boris Schlossgerg, that's I, are employed as Directors of Credit Research of GFT, division of GFT. However, BK Forex Advisor, which is how I'm talking to you now, is a company owned and operated by B&K separately and independently from their employment at GFT. GFT does not control the content of BK Forex Trader FX website, and opinions expressed by me are not necessarily those of GFT, 360, or other GFT properties. So the information should not be relied on substitute of extensive independent research before making your investment decision. BK is merely providing this for your general information. Views of me are not necessarily those of GFT, its owners, officers, agents, or other employees. In addition, any projections or views of the market provided may not prove to be accurate, so will not be held liable for any losses incurred in investment. And we do not render investment, legal, accounting, or tax advice. Please consult a proper authority and a proper professional in that manner. So, bottom line, what happens with the FX markets? Why are the FX markets different from all other markets? First and foremost, FX is a 24-hour day market. I think those of us who trade it every day really begin to realize that how, to be honest with you, FX is really three different markets kind of hybrided into one. It's like the Frankenstein of all markets, right? We have the Asian session, which usually is very quiet, doesn't have a lot going on. Then we have a big move in Europe, and very often we have a completely opposite move in the U.S. Look what's happening in the euro today. We had this massive down move in Europe. Then U.S. came in, we dropped the euro a little bit, and then all of a sudden now the euro is back bid up and trying to crawl its way back up to the 33.50 level. So it's kind of interesting. The more you trade this market, the more you realize that even though it's a continuous 24-hour day market, it has very distinct personalities. And it's really important to understand those personalities. Those of you who know that I trade primarily the Europe to New York cross, the London to New York, which is the most intense, the most liquid, and probably the greatest amount of trade in the market. If you're going to constrain yourself to just 4 hours of trading, just the most intense part of the market, no doubt in my mind that the best time to trade the currency market is between 8 a.m. New York and 12 noon New York, which is what is that? That's 12 plus 5 is 1700, right? 8 plus 5, it's 1300 to 1700 GMT, right? Like right now, pretty much things kind of die out. We're going to go into a relative stall. There may be a little bit of price action on the close of New York, but that, pretty much most of the action is done because London is closed right now. So that's the key thing. It's very important to understand that this is a market of 3 very different personalities, and you got to know how to trade those personalities. Spot is also decentralized. It's another key thing that a lot of people who come from stocks or other markets don't understand. There is no centralized market. There is no one single price. There is no centralized authority that's going to govern what happens. Everything happens on a bilateral basis. That means it's between you and your dealer. So, if your dealer is 25 and somebody else is at 35, well, too bad. You're at 25 because the deal is between you and your dealer, not between you and the market. There is no such thing really as a market. There's basically a combination of tiny lots of little markets, all of which feed more or less off each other, but there is no centralized exchange. It's very important to remember. And that in turn, by the way, means that pretty much FX is a very different business from a customer point of view because customers can't buy bid, they cannot sell offer, and they don't pay commission. They just simply pay the spread. They pay the bid-ask spread, right? Every transaction, they basically pay the bid-ask spread. And the last difference, of course, is that FX is very highly levered. In stocks in the U.S., for example, you're levered 2 to 1. If you're called if you have $25,000 and you're called an active trader rule, you can be levered 4 to 1. If you trade futures, you're levered 10 to 1. Well, in FX, you can be levered as much as 50 to 1. So having that kind of massive leverage, obviously, is interesting and can be very powerful, but can also be incredibly dangerous. And I'll talk a little bit more about that later. But here's the hours, by the way, that FX trades. And as I said, most active time is between 4 a.m. to 12 a.m. But if you're going to trade one particular period of time, you want to trade New York, which is 8 a.m. to 12 p.m. That's when pretty much all the price action happens in the market. One easy way, by the way, for you guys to see this is, don't trust me. You can just take any kind of a charting software and export on an hourly basis the highs and the lows of the euro-dollar candle. And what you will see inevitably, trust me on this, is that the 8 a.m. to 12 p.m. time frame in New York will have the widest candles. And that means that's where the most trading occurs, Okay, so a little bit more in detail as to why FX is no central market. It's every dealer makes their own quotes, right? Markets are what's called over-the-counter, not exchange-based, and there's no global best bid and best ask. The end result of this is that really, if you're going to trade FX in any realistic way, you have to have more than one account. Ideally, you probably want to have 3 accounts, but generally, you want to have 2 accounts. What I mean with 2 accounts, not 2 accounts with the same broker, but at least 2 separate broker accounts. And there's a lot of reasons. Number one, remember, since you're dealing directly with a broker, a million things can go wrong. The broker's website can be down. The broker's service could be down. The broker could just be overwhelmed. The broker, could simply have some sort of regulatory issue. Whatever. There's a million different things, and you're very vulnerable if you have an account with only one broker. Furthermore, imagine the following scenario: you're long euro-dollar, your broker in which you're long is offline. You cannot get out of the trade. You don't know where the trade is at. If you don't have a second account in which you can offset your trade, if you can just, let's say you need to get short euro-dollar to offset your trade, you're basically at the mercy of the broker and at the mercy of the market. And being at the mercy of the market is tough enough. Being at the mercy of the broker and the market really is kind of stupid. So that's why most traders who trade this professionally or semi-professionally always have 2 or 3 accounts. Right, and Jose's saying FIFO rules burden with one broker. Yeah, for me FIFO rules are immaterial because I'm a day trader, so I'm in and out all day long. But for those of you who have longer term positions, you could have first in, first out rules that are kind of annoying for the dealer or for the trader. But generally, the main thing, reason we want to do this is because since this is not an exchange-based market, and you have what's called single point of vulnerability, and you definitely have a very single point of vulnerability if you just use one broker. So my tip number one for anybody who trades is to have at least 2, possibly 3 accounts. And you know what? FX Street is super great for that because FX Street pretty much gives you the names of every single broker that exists here. So it's a great place to go shopping for brokers as you are on the site. Where's Maud? Where's my applause from Maud? I guess she's not in the room. Okay. Pay spread, not commission. Let's deal with that. That's a very, very interesting. You're welcome, Marty. But actually, I truly mean this. When people always ask me, at DK, even though we trade through GFT, of course, it's our own broker, and we trade all of the DK trades through GFT. We don't recommend any particular broker. And whenever people always ask me, which broker should we go to, I always say the first place you should go to is fxstreet.com because it's the best place to go shopping. You can comparison, you can download lots of different demos, you can fool around with all the different things, and more importantly, FX Street has a really good table of benefits and costs of every single broker. The only other thing I would say is, especially for customers who are in North America, first of all, customers in North America don't even have a choice. You have to deal with what's called an NFA licensed broker. That is somebody who is governed by the National Futures Association. But generally, I really believe it's a good idea for anybody in FX business to deal with a NFA regulatory broker because this is the one key thing about this business is that it has no oversight. And if you don't have any oversight, you have no recourse if the broker, goes bankrupt. In the U.S., even though a lot of people are complaining that the regulation is just kind of stifling and killing the business, the flip side of it is that I can assure you that every single broker that is licensed is in really solid financial shape and is every single day being audited. And you can feel relatively confident that your money is in safe hands whenever you deal with the U.S. based brokers. So a little bit of jingoism here on my side. Anyways, in FX you pay spread, not commission. Yeah, and there's a table of brokers, and only regulated brokers appear on that list. That's great. Thank you, Maud. The key thing about paying spread is, first of all, in FX we now quote spread to what I call the fifth decimal point, not even to the 1/100th, but to 1/1000th of a penny, right? That's how everything is quoted. Because if you think about it, a 100-point move is a 1 penny move. That's a very big move in FX. So we quote ourselves all the way out to 1/1000th of a penny, in order to, basically, because the markets are so highly leveraged that even a small move has a meaningful impact on your position. But the other thing that I think is very important is to understand that even though there are lots of different brokers and everybody, has got their own story, the basic market is the cost of a trade for the market is between 1 and 3 basis points, 1 and 3 points of notional value. So to give you a good rule of thumb, if you're paying more than 2 pips for the euro dollar, you're overpaying. If you're paying more than 2 pips for dollar yen, you're overpaying. If you're paying more than 3 pips for pound dollar, you're overpaying. If you're paying more than 3 pips for Aussie dollar, you're overpaying. Generally, the market right now is 1.5 euro, 1.5 yen, 2.5 pounds, 2 Aussie. Those are fair market spreads. If you're seeing spreads wider than that, you should not be doing business with your broker, unless you have a different reason for it. My apologies for the noise. This is New York City. You're going to get that noise all the time. So we will let the ambulance pass for just 1 second. And now we're going to return to our usually scheduled programming. Okay. So here's what I talked about, the essence of leverage. Leverage is a two-edged sword, but in my opinion, it's really a one-edged sword. It's like a samurai sword. It can basically slice you in half before you even know what happened to you. And the reason why is because if you're trading the default, see, the brokers are very smart. They don't, they let you trade whatever you want, but what they do is they default you to 50 to 1. That means they give you credit of up to 50 to 1. So for every dollar you lay down, they give you $50 worth of credit because they know the more credit they give you, the greater the chance you have of blowing up, and the greater they have the chance of taking away your money. So this is the key thing you have to understand. Just because somebody gives you $50 worth of credit, it doesn't mean you have to take all the $50 worth of credit. It doesn't mean that if you have $1,000 in your position, you should be buying $50,000 worth of euro dollar in your account because 2% move against you, just a 2% move, basically something that happens intraday half the time will wipe out your whole account. So leverage is very, very important to understand. Now, one cool thing about FX is it's a very evolving market, and there are lots of different models that are coming into the market. So I just took a snapshot of a couple of different FX trading models because I think it's very important to understand. The common model that has always been in FX for the longest time is called direct dealer. That's basically the old-fashioned where you deal directly with a dealer. The dealer makes the quotes, they're the market maker, and you trade against them. Now, you trade against them, I guess, in a literal sense, not necessarily in a figurative sense. What I mean by that is that the dealer is the counterparty to your trades. They take all your trades and they absorb all your risk. Sometimes they'll sell off your risk, sometimes they'll keep your risk. It's up to them. But the point being is that they are on the opposite side of that trade. The pass-through model, which is used by some brokers now, which is like, for example, FXDM used the pass-through model, is nothing more than just the dealer marking up the spreads, taking a commission on the trade and passing off the risk to the interbank market. So the dealer himself does not take the risk. He's not trading on the counterparty deal side. He's just simply putting UBS or Deutsche Bank or Morgan Stanley. He's bundling up all of your orders and sending it to them and giving their standing on the opposite side of your orders. Now, the argument for that is that essentially it creates a friction-free environment, but it actually doesn't, because what it does is it simply creates a commission-layered environment. If you think about it, how does the pass-through broker make its money? Pass-through broker makes its money by charging you much more for the spread than a direct dealer. That's why you'll see very often that the pass-through spreads are higher than direct dealer spreads, because the only way they can make money is if they charge a markup on top of a markup. So you have that kind of situation that goes on the pass-through dealers. And then lastly, which is a new model that's developed. Oh, by the way, like another direct dealer you can see here, this is Oanda is a direct dealer. So you'll trade directly against Oanda. And one of the things that, of course, direct dealers will do is, when things go, when news comes out, they have the right to do whatever the hell they want. And there are some direct dealers who will really widen out their quotes. So it's very important if you're trading against, with a direct dealer to understand that if they're going to widen out their quotes 20 wide on a euro dollar for 5 minutes, you need to be aware of that. Otherwise, you're going to get completely killed by that business model. It's very important. I think that's why to really trade with many of these guys on a demo basis or on a small amount of money basis to understand all the quirks. There's 100 different ways of how you interact with everybody, and everybody has their own unique quirkiness. This is not like stocks where everything is similar. Everybody is different, and you have to understand and learn all of their particular habits. So the last one is what's called ECN, which is really electronic communication network. This is probably the closest thing in the FX market that we have to the exchange-based markets, where you have a platform. Again, this is not an exchange because not everybody participates in it, but you have a platform basically where you are now charged a commission. You do have the ability to make bid and make offer. In other words, you can come in here and be 55 bid and hope that somebody comes in and sells to you at the bid, or be 55 offer and hope that somebody lifts you on the offer. And it looks very similar to those of you who trade futures. It looks very similar to a futures platform in the sense that you have a ladder, you have bids and offers on both sides. You can position your orders inside the ladder. And most importantly, the big difference here, of course, is that you're paying. If you're taking market, I'm going to pay a 55.7, which means I'm paying the 7 cent spread, and I'm paying a commission on top of that, because this particular broker obviously is not going to be taking the spread. He's just going to be taking commission on the move. Generally, a good rule of thumb of how much commission you should be paying is this. If you're paying, the way it's quoted, by the way, and this is another very tricky thing, commissions are quoted on half the order. That means you charge commission on the buy side and you charge commission on the sell side. So when they typically quote it in order of millions. So if somebody says to you it's 50 a million, right? 50 a million, to translate it to basic retail speak, is half a pip. 50 on a million is half a pip. And the key thing here is remember, it's 50 million to buy and 50 million to sell. So what that means is that your commission, your total commission on a transaction, on a wraparound transaction, is one whole pip. If you're paying that, you're paying way too much. Now, of course, all the brokers are going to, they try to massage it by telling you, oh, it's only 15 million. Doesn't sound like a lot. But in fact, you're paying half a pip in, half a pip out. A very good price is probably 20 million. 20 million, which is 40 round trip, which is 0.4 of a pip. And basically, if you can pay half a pip commission to both buy and sell, that is on both sides of the transaction, you're probably doing pretty well. That's a pretty fair market price, right? So I would say these are the 5 things to consider when you're choosing a FX platform. Spread is number 1, and it's a given. But just as importantly is slippage, because you could have a platform that could be half wide on the euro, but if every single trade you make, it slips you a pip, right? You're buying at 51 and actually exceeds at 52, then the effective spread is 1.5, right? So it's very important to audit your statements and see how much slippage you're getting on any of your platforms. The third thing is ease of order entry. One of the key things that you really want out of a platform is the ability to always wrap around an order. So if you're coming into an order, you want the automatic ability to put out a limit and put out a stop on the order in the platform. You don't have to manually hold the position. The other thing that you'd like to have, which is a very nice to have, is that if you have a time limit, let's say you want all your orders to expire after 12 noon New York time, the platform should also have that functionality and allow you to put that on there. Because very often, sometimes we'll leave orders, we'll leave a desk, and sometimes we can't be around, or we're not anywhere where the platform does not have mobility. Mobility is another thing that I would say is very important. Most platforms have mobility at this point, but even if they do, sometimes we forget to lift orders. So having a timed stop is very important, and having an ease of order entry is very important. Having good charting, nice to have. That's why it's a 4, not a 1, but it's definitely an important thing. And lastly, a lot of people underestimate this. I think this is a very important thing, which is having good, clean reporting. There are some platforms that have great reporting, but basically all you got to do is press a button, and every single trade is married for you. You know exactly what you bought and sold. You know exactly your P&L. You know exactly what happened when, and it's all nice and tidy. And there are other platforms where it literally takes a forensic accountant to be able to fully understand exactly what happened. So it's really important when you're doing a lot of these demos, run a demo, run 10, 20, 30 trades, and then go look at your user statement and see how the reporting statement is. If it's complicated, then, weigh that against what kind of a platform you're using. News sources. Everybody like this slide? Everybody in New York really loves this slide. News sources. A lot of people need to understand that basically FX trades on news, right? And I think that's really important. What really drives the market is news. But there's 2 types of news, and this is why it's so difficult to trade this market. There is what we call scheduled news, which is the economic calendar, right? And then there's unscheduled news. And unscheduled news is the unexpected stuff that comes across the wires. Christine Lagarde sneezed the wrong way. Ben Bernanke decided, today he wants to be a hawk. That kind of stuff that can just completely wreak havoc with your position. Because, and this is the key thing, the FX market that people don't understand is very, very fluid. It will react in a completely, it will make a 180-degree turn with no problem. It's a mercenary market. Nobody is 100% committed to their positions. And if facts change, positions change. So news is really important to monitor. And to that end, there are 2 good websites. One is, Forex Factory has a very good calendar, but so does FX Street. And I think, these are 2 very good websites to monitor news for yourselves on a basically minute-by-minute basis. FX Street also has a great Twitter feed, which feeds everybody else's commentary into it that I think is really, really good to follow. Here's the 2 various calendars that you have. And, of course, the great thing about this is that this is all free, whereas if you were to buy a Bloomberg terminal, that's $2,000 a month. If you're going to buy a Reuters, it's about $1,800 a month. It's just, I think, exorbitant to pay that much money, frankly, without much need, because, there's so many good news sources to get. Twitter is obviously a great news source. Anybody in this seminar who does not have a Twitter account, you really should not be trading. I mean, you really should not be trading. That's just about as simple as I can say, because it is the absolute go-to platform now for basically understanding what goes on every single day in the market. Another website I kind of like right now is called Talking Forex. It's pretty cheap. It's like $20 a month, and it gives a running commentary of the market. Although, frankly, I got to tell you, I've tested this thing out, and there's nothing extraordinary special. There's almost nothing here that I haven't been able to find for free anywhere else. So, but if you want to spend $20 just to test it out, it's fine. I think it's worthwhile. Now, I'll put this slide up here, and of course, everybody. I'm actually going to probably put this presentation out to the VK website. If you come visit us at the VK website within the next 24 hours or so, I'll put this presentation on the VK website, and so you guys can follow all the rules. But the idea here is that anybody who's not here, who wants good macro fundamental FX stream, I already have a great compilation list called Macro FX. And all you got to do is just copy my list. And this is the instructions from Twitter on how you can copy my list. So I'm going to conclude this conversation by just giving you the 5 things that move the currency market, and then we can talk a little bit about trades and anything else that's going on. First and foremost, central bank. Anything central banks do, central banks say, are the single most important thing. Which is, and by central bank, I don't mean just the central bank decisions, but anything and everything regarding the central bank. That means if the chairman of the Fed trips over his shoes, that is more important information than anything else that goes on. So why do we have, for example, the dollar rally yesterday? Because Ben Bernanke did not say he was going to keep the rates low for the rest of his life. He didn't even say he was going to raise rates. He didn't say anything that was really hawkish. He just simply wasn't nearly as dovish as everybody thought he would be, and that was enough to push the dollar 150 points to the downside because it was a big central bank decision. Remember, central banks control money, and we trade money. So central banks control us. If you don't understand that, you will not understand anything else about the market. If I can just leave you with this one idea, which is that central banks is the single most important thing you want to follow. The next most important thing is basically what a stock market is trading, because stock market drives what's called risk sentiment. And risk sentiment is basically how are people, Joe's saying that's because Ben is trading Forex now. That's an inside joke from my friend Rob Booker. Capital markets, equity markets are basically continuing on a thing called risk appetite. Risk appetite is basically how positive are investors feeling about the economy and how they're feeling about risk assets. And within the currency market, the risk asset, the predominant risk asset is the Australian dollar. Generally, the way it works is currencies with high interest rates are riskier currencies, and currencies with low interest rates are not riskier currencies. So when equities go up, high interest rate currencies rally with them. When equities fall off, those things sell off. That's kind of the trade-off. Political uncertainty is another key thing because currencies are political as well as economic assets. So you certainly want to keep an eye on political headlines, although they rarely have a major effect on the currency market unless you literally have riots in the streets. I mean, if you have riots in the streets, if you have very, very serious political upheaval, it will definitely affect the currency very badly. So it doesn't have a big impact on currency, but when it does, the impact is kind of huge. Another key thing that we look at is trading capital flows. Trading capital flows is basically how big a current account, how big a capital account does the country run. So a country like Japan, which runs a very, very, and people ask me, why is Japanese yen so strong? Well, Japanese yen is so strong because the Japanese constantly run a trade balance surplus. They constantly, buying dollars, and they don't need, they're constantly selling in dollars, and then having to bring it back into yen. So when you have that kind of a flow, it doesn't matter if the country has a lot of debt, because they have a net surplus of cash every single year. It makes their currency very, very strong. The last and sort of a quirky kind of a thing, and this happens rarely, but it can have a big impact, at least on a very short-term basis, is what's called M&A flows. Let's say a European company makes a bid for the British company, and let's say they make a bid for like $5 billion, right? Well, that company is not price sensitive. It doesn't care what the price of the pound is. It just needs 5 billion pounds. So when that happens, they may come in and do a lot of pound buying, irrespective of whatever is happening in the market, and that could skew the market for 24 to 48 hours. Sometimes when you can't explain what happened, sometimes when you have no idea why the market moved in a significant manner, very often the reason is M&A activity. So one other thing I'm going to show you, a lot of people have asked, how do we look at trends in the currency market? We basically use Bollinger Bands, 2 standard deviation, 1 standard deviation. And the way we look at it is this. When you overlay the Bollinger Bands onto a price chart, anything that's in the 1-2 band is an uptrend. Anything that's in the 1-2 to the downside is in a downtrend. And then whenever we're, in the middle, we're in the range zone. That's kind of how we look at charts. What this does is it allows you to understand that, for example, the New Zealand dollar has been in a very strong uptrend and in a uptrend channel. And similarly, then it was in a very strong downtrend and downtrend channel. And then when it broke that channel, then it typically tends to have a swing move the other way. Of course, some swing moves fail. Other swing moves actually have a big turn. But the point is, you certainly don't want to be short something like around here. You clearly want to be short something when it's around here, right? And that's how we use the Bollinger Bands to trade. You can also use them to pick tops and bottoms in the sense that, we like to, for example, do what's called a turn trade. A turn trade is like when it breaks from the downside, we're buyers. When it breaks through the downside, through the upside to the downside, we're sellers. So you can buy here, sell here, buy here, sell here, sell here. And I think 1, 2, 3, 3 out of 4 are successful trades. You can trade it this way. The last thing I want to leave you with is FX money management. And I had just got one very simple rule. And that is that as a day trader, I never, ever, ever average down. All I do is if I'm wrong on a trade, I just stop myself out. I go on to the next trade. The reason I have this photograph is because this is Paul Tudor Jones, probably the single greatest hedge fund manager in the history of the world. Has been trading for more than 30 years. Made billions of dollars, and is an old-fashioned, old-line trader. He does not use algorithmic trading. He doesn't use, he doesn't cheat. He doesn't, use inside information. He simply trades. And his number one rule, as you can see over here, is losers average losers. That's really the whole thing. If the single best behavior that you can do, the one most dramatic thing that you will do that will change how little money you lose. I cannot guarantee you make money, but how little money you're going to lose is if you take your stops and don't average down, because that's really the single biggest mistake all of us do, right? We get in a position, we're like, oh, no, this position is going against me, but I know it's going to rally. I'm going to add to the position, and very soon that position turns into a disaster. The key question that you want to ask yourself is, are you trading the position, or is the position trading you? Are you trading the market, or is the market trading you? That's really the big question that you face when you trade FX. So with that, I'm going to just, leave you with all of our BK stuff. This is our BK website. Feel free to come visit us. I'll post this presentation on in a slideshow, so you'll be able to just watch it through your web browser right on our website. Right underneath in the member privileges section. So all you got to do is just come in here. It's in the member privileges section, and I'll post it out. Maybe in about a day or so, and then you'll be free to look at these slides if you want to see more detail. Anyways, I'm going to conclude my presentation and just leave it up to the floor now and see if you guys have any questions you want to ask me. Someone is asking me, can I tell you who to follow on Twitter? Well, I just did. Within this presentation is a list called FX Macro. If you follow me and you simply copy my list into FX Macro, you will then be able to follow everybody who I follow, who I think is worthwhile. So you don't have to do any work. I think the euro dollar is clearly hurting, although it's hard to say whether it's in a downtrend or it's just simply consolidating at this point. But it's definitely, as I said earlier today on my Twitter, it looks like it created a distribution at around 34.50. It may begin to rally a little bit up into that level, but I don't know if it's going to be able to sustain that move. I don't use any other text aside from BBs. I mean, I use my roller coaster RSI roller coaster trade, but that's for another time, another setup. I'm basically pretty much a pure price trader. I don't think you really need that many technical indicators. Technical indicators tell you two things: price is either trending or price is losing momentum. That's all they tell you. So I don't think you need anything difficult to analyze price. Technical indicators do not tell you where the price is going to go next. Okay? All they tell you is that, the price has stalled, and then you can speculate, well, maybe it's ready to turn, or the price is in trend, and then you can speculate that maybe it's going to continue. But that's all technical indicators tell you. Any other questions, guys? No? No more questions? Any trades you guys are doing? There's a question for Valerie. I don't know what's a good pip? I don't know what that means. Okay. It says it's not for Valerie. Okay. I don't know what the pip value is. The other thing I would say is that, no, I don't look at correlation. The thing about correlation is that the moment it starts to work is usually when it's going to start to fail. So what I mean by that is that when things start to align in one direction, by the time you figure that out, that's usually kind of the end of the trend, not the beginning of the trend, I mean, there's obvious correlation in the sense that if you have strong equity market performance, you're generally going to have strong performance in the Aussie. If you have, lately, if you have strong oil performance, you're going to have strong performance in the Norwegian NOK. But that's about it. That's all you can do. I don't have a guess on the NFP, although I will tell you I don't like the fact that the ISM today came in a little weak. It's going to be tough to see. We'll have to see the ISM services. The best predictor of NFP is the ISM services report, which comes out on Thursday, I believe, that will give us, the services employment subcomponent will tell us if it's up, then I think there's a reasonable chance NFP will be up. But I think NFP this month may be 200,000, not as strong as it was the month prior. So we'll see. Any other questions, guys? Okay. Bulu's asking, how often should you just deposit withdraw from my broker account? I don't know. It depends on, one, how much do you have on your broker account, how often, I don't really withdraw my money that frequently. Maybe once a quarter, once a half a year. The key idea is not to have too much money in one place. And obviously, I think if you're dealing with a reputable, regulated broker, the money should be relatively safe. It all depends, I personally, I think, putting more than 50,000 into one broker is taking a little bit of a risk. Even with the U.S. broker, it's probably, I would never put more than 100,000 into one broker. But that's kind of like, I find my protection and diversification. I think that's the key thing. For swing, what time frames do I look at? Mainly the daily time frame, for swings. On a daily basis, I look at the hourly time frames, right? Oh, so yeah, one thing that I kind of did not address, it's a great question from Jose. Risk management, if you have a $10,000 account, how much should I be trading? And it's not so much risk per trade, in my opinion. I mean, risk per trade is also important, but it's really how much notional should you trade. In my opinion, you should not trade for $10,000 account. You should not trade more than 100,000 period. So it should never be more than 10 to 1. Your leverage should be somewhere between 5 to 1 and 7 to 1 if you want to survive the business. Even at 10 to 1, it becomes very, very difficult. So, 3 to 1 to 5 to 1 is where you kind of want to stay. So if you have a $10,000 account, you should trade $50,000, lots. And if you're trading $3 $50,000 lots, remember, you're not trading 5 to 1, you're trading 15 to 1, right? Because it's multiplied out. So it's another risk. It's another risk you need to consider. It's not as bad as putting one position of 150 into one position, but it's not as good as 5 to 1. Okay, it's somewhere in the middle. Any other questions, guys? All right, super. I'll put this up on the website soon enough, and thank you very much. And then we'll get back together next month. We'll see how flow goes, and we'll see how RSI trading goes and everything else. Yeah, Euro is starting to bounce a little bit. It's killing me. This trade is killing me because I'm actually trading. Those of you guys know it. I'm trading the RSI roller coaster in the Euro, and it's like pulling teeth today. I was up like 20 pips. Now I'm pretty much flat to even. So we'll see. I'm hoping the Euro rallies to 33.50 in Asia, but we'll see how it works out. Anyways, I wish you guys the best, and I'll see you guys next month. All the best. Take care.